Greetings, traders. This is Coach Robert. Today is October 15th, 2025, and I'm making this video to share what I like to use as a common setup and the indicators and their settings for what is currently available in TopStep X. So we are currently looking at the ES chart, and this is a 5,000 tick chart. Now, I like to use tick charts because I feel that they show the market price action better than time-based charts. For example, if you're looking at a 2 or 5 minute or 15-minute chart, the candle plots simply because a timer expires. Tick charts plot every time transactions happen between buyers and sellers, which I feel gives a better indication of what's happening in the market as far as price action goes. This being a 5,000 tick chart, it means that when 5,000 transactions have happened, and that is a transaction being between a buyer and a seller, it doesn't matter the amount of contracts, that would be classified as volume. Then once 5,000 transactions happen, the candle will plot, and it will plot just like a regular time-based candle or Japanese candle. In my case, I have white as the up candle and black as a down candle, typically green and red. I like to use black and white because when I add an indicator, I can clearly see better that the full direction. So if there were red and green candles here, it can get a little convoluted. It's just a choice. It's certainly for aesthetics and visual purposes only. Use whatever colors you would like. So the tick chart, once a buy and sell happens, it will count as one tick. Now that tick could have one contract of volume or 200 contracts of volume. It still counts as one tick. Now, why do I like this? We can see in a certain area, like this consolidation, there's not a lot of buyers or sellers forcing the other direction. And it just kind of conglomerates everything together and consolidates and creates this little range. This is actually what I look for. I wait for a price to come out of the range above or out of the range below to allow me a potential long or a potential short position. Now, because they are tick charts, there is a significant or can be a significant difference between how many candles are plotted based on time. So for example, if we look from 9 a.m. to 10 a.m., we can see the distance. It's a pretty good amount of distance left and right. But if we look between 11 and 12, there's not really a lot. It's not the same distance. So what this inherently does is as the market volatility picks up and more transactions happen, more candles will be plotted in a shorter amount of time. This makes it easier, in my opinion, to identify consolidation areas, and then when you have larger breakouts, the candles plot faster, market moves faster, and definitely gives you a better indication as to who is in charge, the bulls or the bears. So let's start with the three indicators I have on my chart. On the right is the volume profile visible range. The green and red that you see here, that is actually a version of the Ichimoku cloud. And at the bottom, this is called Directional Movement Index, DMI, or just Directional Movement. And I'll go through all the settings. So first, the volume profile. This is why I'm not too concerned about volume itself, because the volume profile will increase further to the left as more volume happens. So you could have very small candles, meaning not a lot of ticks happened, but you can have a lot of volume. As we see here in consolidation, a lot of volume happened, as we can see the furthest to the left of this volume profile, and the yellow line is my point of control, and that is simply the price level where the most transactions have happened. So let's take a look at the settings. Here are the volume profile. First thing I'm going to do is reset to default. This is what it looks like when you first add to your chart. You have the style, the colors, the different colors of POC, percentage of the box, and then of course what you are choosing to look at as far as row size, that's the distance between these. And whether you're counting up and down volume, notice there are blue and yellow as indicated for value area up and value area down. I like to have mine set differently. So I'm going to change, hit cancel, and go back to the settings. And this is how I like to have mine set. So the number of rows is what is being tracked up and down. I have a row size of 500. For example, if we bring this back down to 50, it puts these big blocks on here, and I don't really think it gives me a great picture. I want to see what's happening in between each of these prices more at the tick level. I have the total volume. We can use up and down volume, which will give us different colors, and delta volume will even give us more information as to, look, this is down volume, but there are more buyers and sellers by changing the different colors. I personally like to use the total because that's really all I'm interested in as far as the volume goes for the day. The value area I like to set as 80%. That would be the blue section. By default, it's 70%. I personally like to choose 80. And for my style, placement is on the right-hand side of the chart, and I like 5% of the box. Sometimes I'll change this if I need to have a better view of where the low volume areas are or the high volume nodes. Typically, when you see low volume areas, price may move quickly through it to the previous area of high volume nodes where there is more interest in buyers and sellers and more interest in volume. So for this sake, let's put it down to 5% where I like to have it. There are developing point of controls. So you can see the developing point of control was this blue line, and now it's the yellow line because it's overwriting it. And you have developing value area. So this is showing 80% of the volume is in this blue section, but we can see that the volume had shifted up until we had a down push that didn't go any higher, and more volume came into the downside. I like to keep nice clean charts, so I really don't leave those on at all. But that's my volume profile layout. Now this is volume profile visible range, so this will change if I scroll the chart. For example, let's scroll the chart, and we can see how the volume profile changed to read what is currently on the chart. So it's not going to remain static, remain constant. So if I want to see the profile for the entire day, I have the blue lines here as my session separators. I just make sure my price scale is back to the current day. If I want to see what happened between the last 2 days, I just simply keep dragging until I have my second day, and this is the volume profile over the course of 2 days. And if I want to see what the market open looks like, here's about 8:30 in the morning, Central Time, and this is the volume profile for the US session. I like to view it for the entire day while viewing the volume profile, so I'm going to leave it right there. Let's move on to the Ichimoku cloud. This is the green and the red spans here. Now, again, I will go and change this to the default, and you can see what it looks like when you first add it to your chart. To me, that looks pretty messy. I don't know too much that I can do with that. Again, it's a personal preference, and these are the settings by default, and the styles, we can see everything is turned on. Now I'm going to show you the reason that I made these changes. First of all, let's go to the style. I'm only using greens and reds, green for up, red for down. I put about 30% opacity so I can see it behind the candles. And it doesn't take up a lot of color from the chart. For example, if I move this all the way to, makes it really bright to 100%. So I like to keep these down to 30%, but go ahead and set it to your liking. Leading span A and B, these are just the outside of the cloud. So I really don't need these on the chart as well. And these are lagging spans. It shows this pretty much the same, but it has an offset to it. These are conversions and baselines, pretty much moving averages that you can set in the input settings. I just like to have it nice and clean, so I only keep the green and red. And here are the settings that I use for baseline and leading span, lagging span. They don't really make too much of a difference. It's the shift period that I make sure I go down to 1. I want it to react right on time. It's the lowest you can go. So it's going to be the last candle. There's no offset. So this is how I like to set the Ichimoku cloud. And this is great for longer hold times and showing the direction of the market. So once we have our green, the buyers had given up and it crosses and now it turns red, and it can give us quite a long way to hold. And I don't know, it just gives you a nice clean picture for directional interest as far as I'm concerned. When you see them really small together, like this red isn't really that wide. This is most likely a stop out. Came down, stopped out at here, turned green, made wider, span. Looks like a nice opportunity to get into a long. And same here, we have these little tiny changes. Kind of stay away from the market at that point. However, we can use volume profile to see where the interest is. And then we're going to move down to this directional movement indicator. Make this a little bigger so it stands out. Now what this is the green are tracking the buyers, the red are tracking the sellers, and the yellow line is called the ADX, Average Directional Index. That is the strength of the direction, not the direction. So notice this doesn't mean it's going up. It means the buyers that are here have control and they're gaining strength. Even though they're dropping off right here, there's a little bit of strength left. And notice it's going up here, but these are sellers that are gaining strength. Pretty straightforward. Just remember that this is not a directional movement. This is just the strength of the current direction. Now let me show you what this looks like with default settings. There is the directional movement index default settings. It's set to 1414 and it has all these lines on here. Now I'm going to cancel this and it looks messy to me. I really don't see that being beneficial. So now I'll show you what I'm using for settings. The DI length and the smoothing length, this is ADX smoothing, I keep them twice the size. So if the DI was 5, the smoothing would be 10. We can see 10 and 20. If my DI length was 20, my smoothing would be 40. Play around with this to see which settings work best for you. This is simply what works for me in my situation. Under the style, DI plus, I have as columns. We can see here, these are columns, and I have them green with 100% opacity on it, so they really stand out. However, the DI minus, the sellers, I have as an area chart. You can use whatever works for you. Again, this is just the way I like to look at it. But the one difference is that I need to reduce my opacity type. Because if I don't, make it 100, I can't see what's happening with the buyers in the background. That's something I feel that I need to know about. So I'm going to make this down to 85 where it was. And now I can see the buyers behind it, but it's not very obtrusive or distracting from what I'm actually looking at. And then, of course, the ADX I have as the yellow line. Now, how this is used is I'll use this as a type of a confluence between price action volume and the Ichimoku cloud. So what I'm looking at here, if we start off with visually, we have the market moving up based on the cloud. We have buyers stronger than sellers. Therefore, we have price movement to the upside. It's not only that they're stronger, there's more than sellers, they're getting stronger as they go. So the buyers definitely have control over this. Now we can see some consolidation right here. Now, why is that? Well, the buyers happen to drop off. There weren't as many, wasn't as much activity, not as much strength. And the sellers came in and they're pretty much equaling out the buyers at this point. So the direction, whatever the direction was, in this case up, is losing strength. And we have some consolidation between the buyers and sellers. Pretty good time to get out of a trade if you see the ADX dropping down and the buyers are dropping and sellers are coming in and you're long. So it might be a good opportunity to get out of the trade. Sure, you can get a couple more points out of it, but we like to play it safe. And now we don't do anything until we have another direction. As long as the ADX is dropping, I like to look at it as there's no strength in any direction. Even when the sellers came in and overtook the buyers, there's no strength there. It is only when these buyers came back in, the sellers dropped off, and the buyers came in with strength, potentially getting into a long position. And we can see that, sure, that was pretty much around a breakout area. Nice opportunity for a long. Buyers continued to gain strength, sellers continued to drop off, but once the buyers started losing strength, started going away, and more sellers came in, might be a good opportunity to get out of that long position. And then the same holds true for the short side. We have buyers and sellers crisscrossing. There's not too much strength. Right here, we have not a bunch of buyers behind the scene. More sellers came in, and we have some strength turning up. So that looks like it's a potential short. Now, we would want to be careful going into a short because we have this consolidation, so we'll really keep an eye on it over here. And we can see a little bit of buyers. The sellers dropped off, and the sellers immediately came back in with strength. Buyers went away, and they continued. That means holding on to that short a little bit longer. So those look like a couple of pretty decent trades. Strength of the sellers in control, strength went away, started chopping around, stay out of the market. Buyers went away, sellers came in. Right here, they came in with strength. Possible good opportunity to short, and it happens to be right below a previous support area, which was resistance area in the past. Turned out to be a pretty good short. Once the sellers went away, buyers came in. It starts to drop off. Probably an opportunity to close that short position. Now I'm going to share one other thing. This goes on the close the other indicators I have on. And this has to do with moving averages. I know a common indicator to use for most traders are moving averages. And the most common is an exponential moving average. So if we go into indicators and I type in moving, look how many there are. There's exponential, weighted, adaptive, double, Hamming, all, Hull, all of these different ones, okay? The most common is exponential. I feel, personally, that the weighted moving average, or WMA, gives a clearer picture. The moving average exponential can be a little choppy sometimes and may get you out of a trade that you may want to have been in a little bit longer. The weighted moving average has a slight different calculation. I feel it reacts a little quicker, but also doesn't react the opposite direction too fast, potentially keeping you into longer trades. And here's the other thing that I do when I have moving averages. I'm going to turn this one on. This is a 20 moving average on the close. Now, a lot of traders would say, let's just say they wanted to have a 40 moving average as well. So they have a 20 and a 40 for two different lengths, and they would play with a moving average crossover. That's not too bad, but I take it a step further. I'm going to use a 20 moving average and a 25 moving average, both weighted, but I'm calculating them differently. So the shorter time frame moving average is calculated on the close of the candle price, whereas the 25, or the longer moving average, is calculated on the open of the candle price. Now, if I change this to changing it to close, it's really, really close. These are pretty tight as it is, but I still may get faked out in some areas, a lot of crisscross. But by calculating it on the open, I have a longer position on the open, a longer look back, and a shorter look back on the close. That's going to signify a faster directional change because I'm looking at a close of the candle. So if there are a significant amount of down candles, for example, right here, or upward candles, for example, right here, it's going to calculate 20 period back, whereas the open would be 25. So it's going to react slower. And I believe you can clearly see that it does make a difference. Your crossovers tend to be cleaner because we're using a shorter and longer calculator on open and close, where we can actually get into these pretty quickly. Look at this area. If you're just doing a crossover trade, there's a typical short, and we don't get out of that short till quite a ways over. And sure, we may be long here. If we were taking every crossover, we take a long, potentially have a stop out, but then we cross to the downside and have another short. And then here we have another long, and we're still in that position. So to me, it does make sense to use the open and close with different lengths. Now, when we combine that with our Ichimoku cloud, we can see that here's an indication. The fast crossed over the slow, so the close over the open. keep an eye for potential short. And then when we have our Ichimoku cloud show up, it gives us a confirmation that, yeah, that looks like a pretty good short. And then we add in our buyers and sellers. If we can see the sellers had taken over, buyers dropped off, and we have some strength. So this to me looks like a pretty good opportunity to take a short. And yes, I know we're looking at hindsight, but this is a demonstration. If this were real time, you would see this. This would be the real time view that you have. We have a crossover. We have the cloud collapsing. So we have a potential to the downside. Our Ichimoku showed up, and all of a sudden the sellers came in, and the strength increased. So the short position would be here, for example. Now this isn't necessarily a trading video, but I'm just more of an indicator video. But you can see the sellers drop off. We lose strength. Buyers are starting to come in. Might be a good area right around here. And let's give ourselves a bad exit and see what we look like as far as movement goes. So let's give ourselves a short, bad entry, and then we cover with a bad entry, a bad exit. I'm saying bad because we missed it. There was a little slippage in there. So whenever we're calculating, I like to say I didn't get in as soon as I wanted, and I got out sooner than I wanted to. This is still a 34, nearly 35-point move in ES, just using a very simple, easy setup. So hopefully this makes sense, and it gives a little more insight of how I look at the market, what I like to use. These are the common indicators. I'll put them back on. They are tick charts. Let me reset. Here is the exact layout that I like to use. I understand it's not for everybody, and you will need to make adjustments based on the instrument you're trading, based on your risk tolerance, your account size, whether you're in drawdown or in profit, time of day that you're trading, and of course, the volatility of the market. Hopefully this helps, and hopefully you like it. This is Coach Robert, signing off.